Your dollar is dying in your wallet right now, and most people have no idea it's happening. Not metaphorically dying, not gradually losing value over years like we've been conditioned to accept, but genuinely hemorrhaging purchasing power at a pace that should terrify anyone holding significant wealth in traditional paper assets. While financial advisors continue preaching the gospel of the 60-40 portfolio and mainstream media celebrates new stock market highs, something fundamental has broken in the global financial system, and the smart money has already started running for the exits. Gold just shattered $5,000 per ounce for the first time in human history. Silver exploded 147% in a single year. Central banks worldwide are dumping U.S. Treasury bonds and stockpiling physical metals at a pace not seen since the collapse of the Bretton Woods system in the 1970s. These aren't random market movements or speculative bubbles driven by retail investors chasing gains. This is the institutional realization that the emperor has no clothes, that the paper assets we've been told represent safety and stability are built on foundations of debt, monetary manipulation, and political promises that can no longer be kept. So let's talk about what's really happening to your stocks, your bonds, your cash, and why precious metals have suddenly become the only asset class that global financial institutions genuinely trust when everything else is on the line. The United States federal government currently owes $31 trillion to the public. Let me put that number in perspective because it's so massive that our brains struggle to comprehend it. That's 100% of America's entire gross domestic product, meaning the government owes as much as the entire American economy produces in a full year. This isn't just a big number. It's a threshold that economic historians and fiscal policy experts have warned represents the point of no return, where debt begins feeding on itself through interest payments that crowd out everything else. Interest costs on this debt surged to roughly $1 trillion last year alone, consuming nearly 18% of all federal revenue. That's more than the entire Medicare budget spent just servicing existing debt before paying for a single government program or service. The Congressional Budget Office projects the national debt will grow from 102% of GDP at the end of fiscal year 2026 to 107% by the end of 2029, setting new records every single year with no reversal in sight. The Committee for a Responsible Federal Budget published a report in late January 2026 titled, "What Would a Fiscal Crisis Look Like?" that outlined 6 distinct crisis scenarios that could emerge from this debt trajectory. Financial crisis, where reduced confidence in treasury markets leads to spiking interest rates, panic among traders, asset devaluation, credit freezing, and failure of key financial institutions. Inflation crisis, where attempts to manage debt through money printing result in high and potentially spiraling inflation. Austerity crisis, where sharp tax increases and spending cuts push the economy into recession. Currency crisis, where the dollar faces sudden significant depreciation. Default crisis, where the government fails to make debt payments. Or gradual crisis, where living standards and fiscal flexibility slowly erode over time. Several of these scenarios could happen simultaneously, creating cascading failures across the entire financial system. Now, here's where it gets really interesting and really frightening. Traditional safe havens are no longer safe. For generations, investors were told that U.S. Treasury bonds represented the risk-free asset, the bedrock of any diversified portfolio, the place you park money when uncertainty rises. That paradigm is shattering in real time. Foreign governments, which historically served as the primary buyers of U.S. government debt, have scaled back purchases dramatically in favor of alternative assets, with gold leading the way. Central banks purchased 863 tons of gold in 2025, according to World Gold Council data. While that's down from the exceptional 1,000 plus ton levels of the previous 3 years, it still represents nearly double the 2010 to 2021 average of 473 tons annually. JP Morgan forecasts 755 tons of central bank gold purchases in 2026, a level that remains historically elevated. Poland's central bank increased its gold reserves by 102 tons in 2025 and announced plans to boost holdings to 700 tons for national security reasons. Kazakhstan set a record for annual gold buying. Brazil re-entered the market after a 2-year pause. China extended its buying streak to 12 consecutive months. These aren't speculative traders chasing momentum. These are the most conservative financial institutions on earth, central banks managing national reserves, and they're systematically diversifying away from dollar-denominated assets into physical gold at a pace that signals deep structural concern about the future of paper currencies. Let's talk about what's happening in equity markets, because the disconnect between price and reality has reached levels that make the dot-com bubble look rational by comparison. The S&P 500 just completed 3 consecutive years of double-digit returns with valuations at levels that historically precede major corrections. Analysis of current capital misallocation across AI investments, cryptocurrencies, and housing suggests a level of speculative excess that far surpasses the 2008 global financial crisis. The top 5 stocks as a percentage of the S&P 500 now mirror concentration levels from the 2000 dot-com peak, creating massive systemic risk if any of those companies stumble. Marginal AI capital expenditure as a percentage of GDP growth has reached unsustainable levels, with massive investments in large language models and data centers increasingly questioned about their ability to generate actual returns on capital. Goldman Sachs and other major institutions acknowledge that while AI optimism continues supporting markets in the short term, investors should recognize that valuations already price in significant future growth, leaving little margin for disappointment. The problem isn't just that stocks are expensive, it's that they're expensive at exactly the moment when the economic fundamentals supporting them are deteriorating. Employment growth slowed to just 17,000 jobs per month since April 2025, levels that would historically signal a labor market in crisis. Consumer confidence dropped to recession levels in December. The top 20% of earners accounted for a record 57% of all consumer spending in the first half of 2025, while the bottom 80% struggled to make ends meet. This isn't a healthy economy supporting premium valuations. This is a bifurcated economy where asset price inflation has diverged completely from the reality most people experience. Economist Komal Srikumar warned in December that 2026 would witness stagflation levels not seen since the 1970s, a toxic combination of higher inflation and recession that destroys both stocks and bonds simultaneously. His forecast calls for inflation above 3% in 2026, with growing recession risk from trade tariffs and weakening demand. The steep yield curve could increase mortgage rates and cause consumer spending to decline. Fed policy uncertainty adds another layer of risk, with questions about central bank independence potentially undermining confidence in U.S. monetary policy and raising long-term borrowing costs. Here's the nightmare scenario that keeps institutional investors awake at night. A reflationary environment that pushes interest rates higher while driving stock and bond prices lower in tandem. Bonds are supposed to provide ballast when stocks fall. That's the entire theory behind the 60-40 portfolio. But when inflation forces rates higher, Bonds get crushed alongside equities, eliminating the diversification benefit that investors depend on. Wellington Management's analysis suggests this scenario, while not the most likely outcome for 2026, represents a risk that investors must prepare for given elevated debt levels and persistent inflation pressures. Now let's pivot to what's actually working, what global institutions are buying when they need genuine safety. Gold prices posted continuous gains throughout 2025, climbing as much as 55% and surpassing $4,000 per ounce for the first time in October. The rally didn't stop there. By late January 2026, spot gold had surged above $5,000 per ounce, with prices recently trading around $5,073 as of February 9th. J.P. Morgan Global Research forecasts prices averaging $5,055 per ounce by the final quarter of 2026, rising toward $5,400 by the end of 2027. But some analysts see even higher potential. Julia Du at ICBC Standard Bank projects gold could reach $7,150. Nikki Shields at MKS PAMP expects $5,400 this year and characterizes the current cycle as secular rather than speculative, stating this isn't a commodity blow-off top. Deutsche Bank reiterated a $6,000 per ounce target. Societe Generale raised its year-end forecast to $6,000, though it cautions this may prove conservative. What's driving this extraordinary rally? The factors are structural and mutually reinforcing. Geopolitical uncertainty continues escalating, with flashpoints involving Iran, Venezuela, and ongoing tensions that show no signs of resolution. U.S. dollar weakness, driven by policy uncertainty and massive budget deficits, makes gold more attractive in relative terms. Morgan Stanley projects the dollar could plummet another 11% over the next 12 months after already falling 10% in 2025. Federal Reserve policy remains accommodative despite persistent inflation, reducing the opportunity cost of holding non-yielding assets like gold. Most importantly, there's been a fundamental shift in how institutions view gold's role in portfolios. It's no longer just an inflation hedge or crisis insurance. It's increasingly seen as a core strategic holding in an environment where traditional safe assets like treasury bonds no longer provide the safety they once did. Silver's story is even more dramatic and potentially more explosive. After languishing in gold's shadow for years, silver surged 147% in 2025, breaking above the $50 resistance level that had capped prices for over 4 decades. By early 2026, silver was trading in the $90 to $100 range, with brief spikes above $120 per ounce in February. Bank of America raised its short-term target to $170 per ounce. Citi upgraded forecasts to $150. Peel Hunt raised its full-year 2026 forecast by 79% to $75 per ounce and increased its long-run estimate from $30 to $50. Some analysts see potential for silver to reach triple digits and stay there, with technical models stretching toward targets of $250 to $300 if historical gold-to-silver ratios reassert themselves. What makes silver's rally different from gold is the industrial demand component. Silver isn't just a monetary metal anymore. It's a critical industrial input for technologies driving the global economy. Solar panel production alone consumed over 25% of annual global silver supply in 2024, and that percentage increased in 2025. By 2050, cumulative solar demand could equal 85 to 98% of today's known silver reserves. Electric vehicle production is accelerating silver consumption, with EV-related demand jumping an estimated 20% in 2025. Semiconductors 5G infrastructure and the massive electricity requirements of AI data centers all require silver for high-efficiency conductivity. Industrial demand now accounts for more than half of total silver consumption, up 50% since 2015. On the supply side, the situation is dire. 2025 marked the fifth consecutive year of structural deficits in the silver market. Global mine production grew only about 2% to 830 million ounces, with over 50% coming as a byproduct of base metal operations. This means silver production doesn't automatically increase when prices rise, creating persistent supply shortages. China implemented new export licensing requirements in January 2026 that effectively restrict silver exports to just 44 companies, tightening global supply further. The combination of surging industrial demand and constrained supply creates a fundamental support for prices that has nothing to do with speculation or financial engineering. Here's what all of this means for your wealth and your financial future. The investment landscape has fundamentally changed, and the strategies that worked for the past 40 years of declining interest rates and expanding debt may not just underperform, they may actively destroy wealth in the environment we're entering. Paper assets, stocks, bonds, cash all represent claims on future economic output or government promises. Their value depends entirely on confidence in the institutions backing them and the economic conditions supporting them. When the U.S. government owes 100% of GDP and interest costs consume nearly 20% of revenue, when central banks worldwide are diversifying away from dollar assets, when inflation threatens to spiral despite aggressive rate hikes, that confidence erodes. Physical precious metals represent the opposite. They're no one's liability. They carry no counterparty risk. They can't be printed by central banks or devalued by government decree. They've maintained purchasing power across millennia of human civilization through countless currency collapses, empire declines, and financial crises. Gold overtook the euro as the world's second largest reserve asset in 2025 and was recognized as a Tier 1 asset in the international banking system, reflecting its fundamental importance to global finance. The question isn't whether to own precious metals anymore. Central banks have answered that question definitively through their buying programs. The question is what percentage of your portfolio should be allocated to physical metals and whether current prices already reflect the risks or merely represent the beginning of a much larger repricing. Portfolio managers at Morgan Stanley now recommend 60-20-20 allocations, including 20% precious metals, a dramatic departure from traditional 60-40 equity bond models. This represents institutional acceptance that metals aren't just crisis insurance to be held in small amounts. They're core portfolio holdings in an environment of persistent uncertainty. Some investors and analysts who've been watching these trends unfold see even higher allocation targets as appropriate given the magnitude of fiscal and monetary challenges ahead. The mechanics of how to gain exposure matter enormously. Paper gold through ETFs and futures provides price exposure, but not the fundamental safety that comes from physical possession. During financial crises, counterparty risk emerges across all paper instruments. Physical metals stored in secure vaults or held directly provide the ultimate form of financial insurance because they exist outside the financial system entirely. The forces driving metals higher aren't temporary or cyclical. There are structural shifts in the global monetary system that have been building for decades and are now accelerating. The era of unlimited debt expansion backed by nothing but confidence in government promises is ending, not because of ideology or choice, but because mathematics and market forces are reasserting themselves. Interest costs can't keep growing faster than the economy indefinitely. Foreign creditors won't keep financing American deficits at negative real interest rates forever. The dollar's reserve currency status, while still dominant, faces challenges that didn't exist a generation ago. These aren't predictions about the future. They're observations about the present that most investors haven't fully processed yet. Gold at $5,000 per ounce and silver above $90 aren't speculative manias driven by retail fear. They're the institutional repricing of risk in an environment where the traditional metrics of safety no longer apply. When central banks that manage national reserves conclude that physical metals provide better protection than government bonds, when Poland and Kazakhstan and Brazil and China all reach similar conclusions despite having completely different political systems and economic situations, that's a signal that transcends any individual analyst's forecast or political narrative. The smart money has already moved. The question is whether you'll recognize what's happening before it's too late to protect yourself. Paper assets aren't dead yet, but they're on life support powered by central bank intervention and government deficit spending that can't continue indefinitely. Precious metals aren't just an alternative anymore. For an increasing number of sophisticated investors worldwide, they've become the only safe haven left that doesn't depend on someone else's promise, someone else's solvency, or someone else's willingness to honor their obligations when the system comes under stress. The choice of what to do with that information is yours, but the window for action may be closing faster than most people realize.